Initial claims, a real disappointment, at least in my book. We were looking for cycle lows. Current cycle low is 711,000 from November. This zoomed up to 770,000. Now, it's not that big, but it is not a cycle low, and it's actually the highest initial claim level since about mid-February when we were back over 800, of course, 800,000 versus 770,000. And if you look at continuing claims, a bit of a different picture. It definitely is coming in better than expected. I rephrase, not better than expected, but still a cycle low. We're expecting a number of 4.03 million, and we ended up with 4.124 million. That follows 4.14 million. That was the cycle low. So post-COVID cycle low on continuing claims, which are also still too high, and I'm sure we'll talk about some of the emergency programs that aren't in the headline breaking news. Philly Fed for March. All right, I carry a 28-year tail of data in my laptop. It came out at 51.8. The highest I had was 41.4 in 93. So this is a robust number for a March read on Philly Fed Index, and it really does underscore all the horsepower hidden in the economy that the Fed officials seem to be just oblivious to. And right now, we touched 250 in a 30-year bond. That was up 8 basis points. That's the highest level going, if it were to close there, since July of 2019. And at 174 in 10s, that was up 10 on the day. Should it close there, that'd be the best close since January of last year. We'll call it 13 months. And after that statement yesterday, nobody was kind of thinking how dovish it was. I was. There was feathers in the room, and what gave you the clue was the dollar index. And it still isn't actually back up to where it was before the statement was read, but it vacillates. It looks at all the programs, all the stimulus, all the debt, all the watering down of the reserve currency, and it starts to cry a bit. But then it looks at interest rates. It's a tug of war, and it starts to move back up again. Joe, back to you.
Thanks, Rick. Steve Leisman joins us now with more. Do you see feathers there? Did you hear doves when doves cry or whatever that song was?
Yeah, for sure. It was more dovish than expected. I talked to some hedge fund guys this morning, Joe, who were like, well, what are they doing? Why wouldn't they just acknowledge a single hike in 2023? But look, because Rick does such a nice job with the data, I get an opportunity to go back and look a little further here. And that Philly Fed is the highest since 1973 at 51.8 and does speak to the horsepower, at least in the manufacturing sector of the economy. But you know what else was really high here? This prices paid component, which I have at 75.9, which is the highest since 1980. So that whole idea of the manufacturing sector getting up and running, but the supply bottlenecks, some of the commodity price increases, that's an issue. What's also an issue is the idea that we're still doing 770,000 of claims. That's a bad number. And by the way, it maybe backs up the Fed a little bit when it comes to the idea of wanting to see the data of the actual turnaround rather than raising rates or tightening policy on the come. This is a very difficult thing, Joe, to come back from one of these pandemics. Things are out of whack in all kinds of different ways. You have the manufacturing sector coming back strong. Employment may take a little longer, it looks like, Joe.
Shepard Smith here. Thanks for watching CNBC on YouTube.